Hi everyone, welcome back to the podcast. I hope you have a wonderful day ahead of you. And today I thought I'll talk about Warren Buffett's principle of investing and how he goes about investing into companies such as Apple, and why this is the most important way and the most critical way to assess a company, especially in these current times which we are staying in. What do I mean by current times? There's a lot of market volatility, not only in the US and in India. And when you look at it stock specifically, you can see a lot more volatility than looking at the broader index. And in this kind of a current situation, a lot of people will think of speculative returns. Speculative returns is you see the stock dipping today and you take a position on it and expect the stock to go up in a few days or in a month or two and to cash out at this higher point of price. Yes, that is speculative in nature, but it's not something which I recommend that you do, because as you do in option trading and shorting the market, in speculative returns, you can lose your arm and your leg if you're not careful and you don't know what you're doing. So what is the strategy other than speculative returns you can look at? That is investing for the long term and investing on intrinsic value of a company, which is what Warren Buffett also suggests you do. So when you're looking at it in the long term, what you have to focus on is the intrinsic value of the company. And I did do a video with Kesav, and in that we basically spoke about different various forms intrinsic value can be calculated, and we showed different equations how it can be calculated. And at the end of it, I concluded all of this pretty much amounts to nothing, because it is all an estimation or a guesswork on what in future the company can be worth. That is true. You cannot predict. Anand's also said this, that we're not astrologers. We cannot predict how much the company will earn tomorrow, how much it will earn 5 years from now, how much it will earn 10 years from now. Nor can we discount that and say, okay, this should be the value. So then why are you talking about this, Vinod, will be our next question. If you have already done a video about this and you said intrinsic value can be used for anything other than speculating, what is it good for? That is true. You cannot look at it and see the future. I agree on that. But that's not what I'm talking about. I'm talking about the cash flow, which is looking at it right now. Is the company spewing cash? Aside from the price to earnings, debt, another key thing which you should look at is the free cash flow. Free cash flow is an important indicator of the financial health of the company. It talks about how much money can be taken out of the business year on year without affecting the operations. That means, let's say you have a company such as Apple and it's producing X amount of cash in its cash flow by doing its business. Let's say you remove the operation cost and you remove all the other costs the company has to pay year on year, and whatever is left on the table is called the free cash flow. And what is the free cash flow used for? Free cash flow is what is used to pay dividends. It is what is used to buy back stocks, like in the case of Apple did, or it is also used to do further investment, capital investments as a company. So that is very critical, because if that is in a large volume, if that is in a huge percentage, that means the company is creating a lot of cash. And as an investor, as an owner of a business, we all want to own a company which is spewing cash or creating lots and lots of money. One of the main reasons Anand even talks about Tata Group companies in India and says, don't have to worry about debt of the Tata Group, because a simple reason of TCS. TCS is a cash cow. It generates immense amount of cash for the Tata Group, and the Tatas take out this money from TCS in terms of dividend. These dividend payouts is nothing but taking the cash, free cash sitting on the table of TCS, and then using that to recapitalize other businesses and other ventures they have across the board. This is the main reason why Anand says you don't need to worry about the debt of the Tata Group or any Tata company because of the amount of cash they're sitting on, let alone what all they still hold in private, the companies they're holding on privately. So this is the strength of having a free cash flow. And this is why Warren Buffett says you must pay a lot of attention to this in a company. And this is one of the main reasons he invests into a company like Apple, because Apple spews cash. The amount of cash they generate is phenomenal, and you can see it in their books. Anyone who's looked at their balance sheet, the amount of cash they're sitting on. Based on this, there are different ways people determine future cash flow. There's one called the discounted cash flow valuation. Then there's called the discounted rate determination. Then they do a perpetuity value. That means going forward, how much cash will be created by this company, and all this is taken together and they'll create something called the intrinsic value. The reason why I don't put too much weightage into the discounted cash flow and discounted rate determination and all these other fancy terminology which they use is because it is very hard to project going forward what will be the next iPhone which Apple will create, what will be the macroeconomic situation between China, USA or India at that point of time, where will Europe be at that point of time, and how all this plays out is very important, because that is the bottom line for Apple, amount of iPhones they're able to sell. That plus the amount of innovation they're able to pack into the next phone. As you see, the iPhone 15 sales were not as expected, because simple reason, users feel the iPhone 13 onwards has not been any great transition in terms of technology or in updation of the phone. In terms of look and in terms of feel, Apple is moving very incrementally now until the next big thing arrives. And the next big thing arriving is a lot of speculation in the market. Again, pay attention to what I'm saying. Speculation in the market is on AI. Last year it was Bitcoin and all about cryptocurrency. This year a lot of focus for investors and Mr. Market seems to be on AI, and how AI is going to tremendously overnight change the landscape of all and everything which we do. Yes, AI is very useful. AI is a tool like your calculator, but so far AI seems to have not delivered on the dramatic change in landscape it has promised in the beginning of the year when it broke news, when all the global news channels across the world were reporting on ChatGPT and on Bard and whatnot, and how it's all going to change, how it's revolutionizing going to do to our work, to our world, and how people are going to have tremendous layoffs which are going to happen thanks to AI coming. Yes, AI has crept into a lot of the work which we do. I do agree. I'm using AI and I think it's fantastic. But it's not reached a point where work has been replaced. This is what Warren said. Warren said this very famously. He said, yes, ChatGPT is interesting. Yes, it looks kind of scary. But he says, end of the day, you have to have a human being sitting in front of the AI asking it something. It's like a calculator or any other device which you have, a computer. It can only do something you ask it to do. It cannot do something by itself. So that is something to keep in mind. So this is the problem when you do discounted cash flow and you're doing future calculations saying going forward, this is what I see that's going to happen. Yes, you can base that on your past, and that is very true. When you're looking back, vision's always 2020, but looking forward, it is very hard to see where it's going to go. Even case in point of what happened with Chevron buying Hess. The World Energy Council has said by year 2030, we will have reached the zenith of crude consumption as a human species. Meaning from 2030, the World Energy Council feels crude oil consumption will be going on a downward trend. If that is true and if that holds water, why is Enron buying Pioneer? Why is Chevron buying Hess? Why is so much of investment in oil still happening, and why are bets being made in oil? Now, I'm sure some of you who are watching this video have views on both sides. But as an investor, I don't like speculating. I'd like to have some kind of a clear idea where to go. So this is what Warren also says again. If it's not in your circle of competence, if you don't understand it, if you cannot see how energy, if I don't directly deal with energy markets, I do not know what's happening in energy other than putting petrol in my car, I must hesitate and slow down my thinking process before I start walking into commodity markets of oil and into looking at Chevron or any other oil company. That's why Anand's in yesterday's video, he said, I would not invest in oil right now because there's so much of confusion in it. So that is why all this discounted cash flow and intrinsic value kind of loses a bit of steam, wind in the sail, according to me, when you look at it. I rather focus on what it's doing today, which is the free cash flow. So focus on what the market is doing right now in terms of what is pricing the share of the company. Price to earnings. Earnings is very important. So price to earnings gives you a rough indicator. Is the price share overpriced or underpriced? If the PE ratio looks interesting, the next thing I suggest you look at is the debt of the company. If the company is at zero debt or close to zero, it is something even better. Because the simple reason, like Anand has harped on many more than I have, is the Fed interest rates are high, and even if they do bring the rates down, it will not come back to zero. And no fund manager who is below the age of 45 has seen or lived at a time where the interest rates have been this high. So majority of us do not know how high interest rates are going to play out. Yes, during the last 20 odd years, we have been having a lot of cash being pumped into the system. That fostered a lot of innovation, it fostered a lot of growth. Will that be able to be replicated in high interest rate environment? I don't think so. And why haven't we seen housing prices correct or crash? It's going to come. As Charlie and Warren have said, that storm is coming in a matter of another couple of years, because this always takes time to catch up. When you raise the interest rates, EMI start going up, companies look for refinancing, and the dominoes start falling one by one. If you have ever seen dominoes falling, we're looking at the last domino, waiting for that to fall. But you got to realize, all the other dominoes before that have to fall first before it reaches the last domino. So keeping that in mind, look at the price to earnings, look at the debt in the company, make sure the debt is zero or negligible. Then the third thing which you should focus your attention on is the cash flow. This cash flow is important because it's pure cash, and that is what is going to create this margin of safety, what we're talking about. Why does this play a key role in margin of safety? Because if the company is able to generate a lot of cash after operations, after everything else it pays out, that free cash that's sitting on the table is fantastic, because that is the cushion as an owner you have, as an investor you have. Let's say the market's turned down. Let's say there is no growth in the market. Let's say for whatever reason you need to do a sudden capital expense for your business. A new factory needs to be built, or an old factory has to be refitted because of climate change. There is some seismic change. If a company is sitting on a lot of free cash on the table, that kind of a pivot is very easy to do. Even in a situation where sudden requirement of dividends need to be paid out to the owner or to the investors like us, it can be met. So these are the main reasons why free cash flow is something vital to look at in terms of margin of safety, not only the price and the earnings of the company. Anyway, this is something what Warren looks at, and I thought it would be something interesting to share with you, and why the way he looks at Apple is very different than just looking at it in terms of the technology or the phone they're creating. He looks at the company in the terms of the amount of cash it's able to generate, and it's sitting on cash. I hope you found this podcast interesting and informative as always, and I'll see you in the next one tomorrow. Thanks.